Hey everybody, I am back with another trade breakdown, and what I wanted to do today was break down um, what I think is my best trade of the week on 6E, otherwise known as Euro USD futures. And I felt the need to break this one down because specifically on this day, um, I was able to recognize why I wanted to trade currencies as opposed to indices because I was able to recognize that NQ was probably going to have an unfavorable day based on previous price action. So I want to break that down because I think that's going to be really helpful for someone who doesn't have as much experience in that area there. So um, we're looking at an hourly chart here on Euro. Okay, and what I'm typically doing, or I shouldn't say typically, but what I'm doing every single day is I am marking out my important points of liquidity that I'm looking to target or look at as potential areas for a trade to like originate from, right? So I use these areas as draws on liquidity and for where a trade can originate from based on time. Okay, so I am marking out my previous week high, my previous week low, the previous day high and low of the last 3 days. Okay. And I'm only focusing, like, if you do a 3 day look back, I'm only looking at highs and lows that are untouched. So if we take a look at, like, if we go to our daily chart right here, and we're looking at this day, we have one, two, three. This is our 3 day look back. We can see these highs are all taken, these lows are all the way down here, so they're kind of um, I didn't mark these ones out because they were kind of out of the question, but I marked this one out just in case because it was the previous day low and it was also a daily BISI right here. So I wanted to have that marked out. But really what I'm looking at is this previous day high and this previous day low right here. So order flow is obviously bullish at this point. And how do I know that is this delivery from the daily BISI, and we had delivered from internal liquidity at this daily BISI to external liquidity at this weekly swing high. So pretty much if you take a look at this range right here from this high to this low, I can mark that out in like yellow. This is the range that this leg in price went to deliver from, or deliver to, I should say. So that's really what we were working with right there. And what I'm using as like an external draw on liquidity, um, because this is a really important point here as well. You can see that since that move has already happened based on the conclusion of this day right here, so the previous day candle, it already took out this weekly swing high. Why am I not looking for shorts after that is because if we take a look out at higher time frames, even higher from the daily, we can see that not on the weekly, there's nothing over here besides, we have a big gap right there, but on the monthly, based on this delivery of the last few months, trending higher, obviously. And what do we have above this high right here? Because this was relative equal highs on the monthly chart, this high and this high right here. What's above that is this monthly fair value gap right there. So I was using that this week as a draw on liquidity and not trying to pick a top, okay? Because again, we had already taken this weekly swing high, and it looks like we potentially completed this market maker buy model, right? Movement down to the daily BISI, movement up to weekly swing high. Maybe now we can look to short towards previous day low. Wrong, right? Because you have to look at the higher time frame picture and zoom out. What are we overall drawing to, right? And that's by no means me saying that we couldn't have gone down here and that would have been a valid thing to expect because I honestly was expecting that. But based on the morning price action, time, it was telling me something otherwise. Telling me that, okay, maybe we aren't actually going to go down here. Maybe we're so bullish and we have a reason to keep going higher, hence up here, as to why I wouldn't need price to go down here. In fact, it would be even better because it would tell me that price is even stronger in my favor of being bullish, right? So just because we took out highs doesn't mean you're automatically trying to short. Now, why was I more interested in Euro than NQ today? or the indices is because if you can see right here, this is our previous day high. Okay, so I want to go into the next day of the actual trading day we were looking at and go up to about right there's okay. So really we're working within like this range right here, right? We got a lot going on. This is why you need to focus on those main points of liquidity that I was talking about, is your previous week high and your daily highs, right? The last 2 days. We can see that I have previous week high marked out right here. We had already taken that, okay? This was a previous weekly swing high. What do we have left on the higher time frames is a previous day high and a previous day low. So this is still left intact. This important liquidity is still there. Okay, so just because we had taken these already doesn't mean I'm trying to short. We still have engineered liquidity that I can use to target. And what are these right here? These are relative equal highs resting right below the previous day high. Same thing right here. These are relative equal highs, right? So we have engineered liquidity from the previous day high going down within this range right here. Okay, so that was the reason why I was still confident in going long and not trying to go short. The reason I chose currencies and euro over NQ is because if I go and take a look at NQ right here, whoops, let me find my spot. If we go take a look at NQ right here, where is your previous day high? Right here, right? That's your previous day high. Was it already taken? Yes. So what liquidity am I going to target, right? Previous week high was already taken. We're well above that. What do I target right here? Nothing, right? There's nothing for me to target. The last 3 days, they're all taken. 3 day high, last 3 day lows taken. They're all resting down here. So I'm not going to try and short this when we're right near all-time highs. And I'm not going to try to long because what liquidity in here that's shorter term as opposed to all-time highs is there for me to target? Nothing, right? And I don't want to try and short to target this right here. I would rather wait for a move down to then go long because I'm not going to try and fight order flow. So at that point, there is nothing here that's telling me is high probability. And sure, you can go in there and you can try and find a trade, right? You probably will be able to find a trade, but don't be surprised if you end up getting chopped or you end up taking a losing trade, right? Because this is just low probability conditions to me based on targets, right? The draw on liquidity is always the most important, and I'm always looking at what engineered liquidity is there that's session highs or previous day high or low or weekly high and low that is in the direction of the higher time frame order flow. And Euro still had these things left intact, so that's why I chose it. Now, if I go down to the 15-minute time frame right here, this is really kind of where we start getting into the meat of it, right? Is because I want to be looking at, now that I have established my higher time frame order flow, I want to be looking at where is my session liquidity resting. So the indicator that I use is right here. It's called ICT kill zones and pivots. It's not mine or anything like that. Like I didn't create it. This is something that I got on or that I use on TradingView. And simply what it's doing is it's marking out every single session liquidity for me that I find relevant. So we have London high and low, Asia high and low, the previous day New York PM session high and low, previous day New York lunch session high and low, right? And then these from the previous days is the same thing, London high and low, Asia high and low, etc., right? So I'm looking at all of those and determining and walking myself through what would make the most sense. Where is my most recent level of session liquidity that could be swept in order to go higher? Now, if I want to go higher, I want to see these left intact, right? What is all of this resting below previous day high? Session liquidity, session liquidity, session liquidity, right? All of this is engineered. It's looking like low resistance liquidity. all right here. And it's even better. It is so much better that it is session liquidity, okay? Because that's a high probability target. Now, we got to look at where we're currently at in price. Where is the most recent session liquidity resting, right? We got London high up here and London low right here. If I want to go higher, where do I want to see price go first? Lower. Where? Session liquidity. London low is right here. That is a huge, huge form of liquidity where a lot of my trades originate from. Because if I'm trading New York AM session, where or what's the most previous session is London, right? So if there are London highs and lows still intact, then I want to see how we're going to respond once we go and take those areas, okay? Now, the next step in this process is just making sure that you're looking for these things within the correct time frame, right? Because I'm not looking to trade Asia session as soon as the market opens and looking for a stab of liquidity high and then going for something else. I need to see this happen between 7 a.m. and 9:30 a.m. Okay? So that is a really important point and something that you need to make sure that you're following. That's a really important rule because once you see this thing work, you're going to be thinking, holy shit, I need to wait for anytime there's session liquidity taken, I need to wait for this thing to happen. That's not the case. Time needs to be on your side, and if you're trading this at the wrong time, you're going to take more losses. Sure, sometimes it'll work, but more often than not, you're going to take more losses. And you can have a really, really high win rate trading if you're patient enough to wait for the right time for these things to happen and make sure that you're trading with higher time frame order flow. Okay, so that's just a little side note right there. Now, I fast forwarded price a little bit because I wanted to mark out 8:30 open right here, and we need to take a look at time as well on a different aspect as far as premium and discount goes. So your important time frames that you're looking for and monitoring every single day is the current day true day open, which if you could see with this vertical line right here, this is when Wednesday started. Okay, so this is 12 p.m. Or 12 a.m. Eastern time. Mark that price and draw it out. That is your true day open. If you're above it, you're in a premium, and if you're below it, you're in discount. Okay, so we're below it, we are in discount. And look how price reacts to these levels as well, especially when they're in line with fair value gaps. All right. Same thing with 8:30 a.m. open. If you are trading below true day open and 8:30 a.m. open, you are in an extreme discount. And then vice versa with premiums. Okay. You can also apply this to 9:30 a.m. as well, especially. So I am marking out every single one of those time frames. It does. I don't need to be below both of them if I want a long. Sometimes it's not going to be that way, and that's why you can, use just one of them. But if you're below both of them or all three of them, and the technicals are telling you that we're bullish, then you're at an extreme discount, and it's looking very, very good if you can find an entry there. Okay, and everything aligns. But again, right now it is 8:45 and this candle just took London lows. So I have alarms set at these highs and lows. If I am bullish, I want to set alarms at the lows right here and really just kind of put my phone away or not look at the screen and just wait till I get an alert that this has been taken right here because now liquidity, that's session liquidity, has been engaged. That's inside of this 15-minute fair value gap as well. So this is when I'm going down to like my 5-minute time frame here. Okay. You can see I have some things marked out already. That is my mistake, but what we're looking at is this leg of price action right here in the current dealing range that we're in. Okay, because just because London low gets taken right here, that doesn't automatically mean that the first like inversion fair value gap you see is going to be a good long. You got to have other things in there as well because again, there still is session liquidity resting below here. There's New York AM low from the previous day, and we have a previous day low right here. Why would I not want to go down here? Well, we're going to get into that. Didn't need to. Um, so we're looking at the current dealing range and where we can find high probability setups to form. Because using dealing ranges, you can literally predict with a high degree of probability where a fair value gap or where an order block is going to form that you can use as pyramid entries or just a way to monitor your positions right here. Okay, so what is a dealing range? A dealing range is when a high and a low has been taken and you're looking at that price leg. Okay, so if we're looking at where we're at in price right here, right now, what low did we just take is London low right here. Okay, we just created a swing low right here. What was the last buy side liquidity external that we took? Well, we take a look at right here and we just keep going back, keep going back, keep going back, bang, right here. We took this buy side, right? And that was the move that sent us lower to go take sell side right here. So this is your dealing range when buy side and sell side have both been taken. So once you have your dealing range and everything else is in alignment like what we're talking about right here, you can take your fib from your low, anchor it from your low of the dealing range and go to the high. Okay, and then you're going to mark it. Now you've got important points right here. You have the lower quadrant, the middle, and the upper quadrant. These are going to be the areas where you want to see fair value gaps and order blocks form because those are going to be the most trustworthy and high probability PD arrays. Now that is a fucking gem right there. So if you're watching it up to this point, which I bet a lot of people are not, and I might be talking to a void, but if you are watching it, you need to write that down because that is something that people put in courses and or just don't even know. They're oblivious to it. This is something that ICT has taught. This is not me making it up right here. This has to do with market maker buy models and sell models. This is how you find your A plus PD arrays. Okay, I cannot stress that enough. Now we're looking at this little section of price action right here because your low risk buy in a market maker buy model is going to form around the 70 or the lower quadrant level. Okay, that is huge. Your low risk buy will form around the lower quadrant of your dealing range in a market maker buy model. So if we're looking at this little internal market maker buy model right here, we got a high and we have a low and we have an obvious move lower right here. Now what we want to see and anticipate is a return to this dealing range high at least. We don't need to target everything up here. It's better that we have external draws on liquidity that would make price want to go higher. But you don't need to ask for too much. All you really need is your dealing range low to your dealing range high, and then you can leave runners for these areas up here, right? But we're looking at a high to a low in a market maker buy model is what we're expecting. What is going to give us more confidence that this is actually going to form and we're not just going to do something like this, like go take out this little high right here or go take out this little high right here and then just dump and keep going lower towards that previous day low or something like that, is we want to see our three PD arrays that give us that confidence and that reassurance that we are changing from a market maker uh, sell model into a market maker buy model, right? Or we're just switching from a sell program to a buy program. Okay, so those three PD arrays are going to be your change in the state of delivery, your inversion fair value gap, and your breaker. Those are really good signs that we are switching order flow. Your change in the state of delivery. Now, your change in the state is going to be your last however many down close candles that are consecutive that get broken. Okay, so if we take a look at this leg down right here, this swing high, excuse me, this swing high to this swing low, This is the run that took out London low right here. This swing high to this swing low. Where are your consecutive down close candles? Right here and right here. What do we have within that leg is this SIBI. This is your 5-minute fair value gap right here. Okay. Now, I'm anticipating that this is going to be an inversion fair value gap. What I want to see is a close above this and a close above these down close candles right here. That to me is going to tell me that there is a change in the state of delivery. What else do we have is these up close candles right here are going to be your breaker. Okay. This is a better breaker up here because this swing took out liquidity. This one did not. So this is really a better breaker. This one's just okay, but I'm looking at this inversion fair value gap and this change in the state of delivery. Where is that happening? Right below 8:30 a.m. low and right at the lower quadrant. Where is the majority of the order block and the inversion fair value gap? Below the 75% level. Okay. So it's not just in line, but it's below. And that's telling me that I want to see a clean rip through and not spend a lot of time or make a return back down here because your best PD arrays are going to be at or a little bit below these areas right here. And it's also a way how you can forecast or predict breakaway gaps as well. And we'll get into that here in just a second because I was able to predict what um, would act as a breakaway gap within this trade right here. Okay, so as I go forward, right, we get a close above here. We get a close above the inversion fair value gap. You can enter there, right? It's a more aggressive entry, but you certainly can enter there, and a lot of times I will. Other times, maybe I'll go in with just a little bit right here and then pyramid once we actually break through and set maybe like a buy stop right here at this the opening price of this change in the state of delivery. But you can see that we hang around here for a sec and then rip through, right? So this is displacement through that change in the state of delivery. To me, that is a buy right there. Stop loss would go at this low right here because now with this down close candle, if we're going to be in a buy program, we want to see down close candles act as support right here. What reason would price have to go all the way down here, sweep this, and then continue higher? There's really not because we already inversed the inversion fair value gap and we closed above the change in the state of delivery. If you want to get really fancy and technical with it, you can take a fib and find out the mean threshold of this change in the state of delivery or order block. And you can see this is the midpoint right here. See the body's respecting that. So the the best order blocks, which we're anticipating to be forming at these levels right here, you do not want to see price go back below the mean threshold right there, especially on a closing basis. So there's no reason price should come back down here. Okay, that's the reasoning for the stop loss right here. Where am I placing my target? Take profit is right up here. Okay, so you can see that we have a really, really good risk to reward, 2.75 risk to reward. Okay. I'm not anticipating price to come back down here because of this 75% level of your dealing range, and everything is set in place right here. So now it comes to trade management. You enter, price starts to come in your direction or go in your direction. All of a sudden, we just hit equilibrium of the range, this 50% level right here. And what do we have now is this 5-minute BISI, okay? It is well below this 50% level. So what did I say about fair value gaps that are forming or order blocks that are forming below these levels is you want to see them act as breakaway gaps. Keep going higher. All right, let me get this out of the way. At the same time, during this trade, I was monitoring the 15-minute as well because I noticed that we had this 15-minute fair value gap formed here as well. Where did it happen? Right below this 50% level. So I want to see this act as a breakaway gap. I said to the Discord group, I do not want to see price go, or I do not want to see this gap fill because it's below equilibrium of this dealing range right here. And you can see if I fast forward a little bit, it goes into it. Does it go to the lower half of it? No, it doesn't even reach the midpoint and we shoot higher. Okay, so that's kind of forecasting it farther a little bit. I just wanted to show you on the higher time frames and why I was not expecting price to go below there. And it's better because we have multiple gaps right here as well on the 5 minutes. So the 15-minute kind of covered that for us there. And with these levels, I also use them as areas of managing my trade. So if we hit the midpoint right here and I enter down here, I'll start to move my stop up a little bit. So let's say if I'll show you what I actually did, is I entered on the close of that candle, stop loss right there, okay? And target is right here. Once we hit this midpoint, I start to bring my stop loss up to what I did was the bodies right here because it's still below the inversion fair value gap and it's below or it's right at the midpoint of this the mean threshold of this change in the state of delivery. So that was my reasoning for trailing the stop. Once we hit the upper quadrant, that is the majority of the time when I'm moving my stop loss to break even. And I was comfortable with doing that in this sense right here because I'm anticipating this 15-minute fair value gap to stay open. I don't want to see price come all the way back down here below 50% of this level, which it ends up not doing. So um, that trade management was really good based on these levels right here. And everything that you're anticipating to see is happening. Now, if we think about this is again a little side note for people who really want to dive into these things and understand the market really is where can we expect accumulation to happen is at old areas on the left side of the curve where accumulation occurred, right? So in this spot or sell model right here, we went lower, accumulation, went lower, big area of accumulation. So we created order blocks right here. We had up close candles before continuing lower right here. Okay, so if we're taking a look at these right here, on the right side of the curve, this was used as support and where a second stage of accumulation occurred before moving higher. Okay, so this is how you can anticipate where accumulation and fair value gaps, order blocks, and PD arrays will form, which ones will be higher probability, and how you can manage your trade. So this is just an overall, all-around masterclass on understanding market structure and market behavior as well. We get really nice displacement through, and we get our target hit, and then immediate rejection below. Okay. Um, Runners could be towards your session highs because again, on the higher time frames, we are still very bullish and we have all these session highs stacked right here. So this is where you leave your runners, right? And we end up going and hitting all of those right there. Okay, so that is really just a full in-depth breakdown on this trade and how you could have viewed this market right here. I would say this video overall was like $1,000 course at least. This is pretty much everything that I use to determine what is the highest probability setups and how to read order flow with a high degree of accuracy. Okay, so think about if you approach the markets this way every single day, and think about what we covered right here. We talked about how to know when markets are going to be lower probability, when the price action or draws on liquidity are going to be lower probability. We talked about where fair value gaps are going to form, where PD arrays are going to form. We talked about what are the highest probability PD arrays, right? So all of these different things are how you develop a winning model. And think about if you just aim for 1 to 2 risk to reward and risk the same amount every single time, what you could do over the span of a week, over a month, over a year. So that's going to be it for this breakdown right here. I hope you found this helpful. There was a lot in here, but a lot of really good stuff. So take care, guys. Be safe.